This week, the dollar hit a 4-year low. At the same time, volatility jumped above 20. So here's the question. Is this just a headline wobble, or is FX pricing a deeper shift? One verified receipt first. The U.S. Treasury's January FX report expanded its monitoring list. Thailand was added. That matters because Treasury is telling you, on paper, where it sees pressure. Not a rumor, an official document, second receipt. Reuters described a "Sell America" tone around tariff threats. That's not a slogan, it's a description of flows. When investors price policy uncertainty, they change what they want to own. By the end, you'll know 3 clean markers, one in rates, one in gold, one in dollar funding. You'll be able to check them this week, and you'll know what they usually lead. Now, what actually happened? Over a few sessions, the dollar slid versus major peers. Stocks sold off, then tried to stabilize. The VIX lifted above 20 during the tariff scare. Gold caught a safety bid. That mix is the tell. It says investors were paying for uncertainty. Here's the first mechanism step. Tariff threats are not just about trade volumes. They are a tax and a timing shock. Companies do not know costs. Investors do not know margins. So they price a wider range of outcomes. Second step. When outcome ranges widen, hedging demand rises. People buy protection. Implied volatility goes up. That raises the cost of capital, even if the Fed does nothing. Third step. FX reacts fast because it is pure relative pricing. If the U.S. path looks noisier, the growth premium gets questioned. And if rate differentials are expected to shrink, the dollar can soften. Even before the data moves, this is where the story gets interesting. A weaker dollar can look like easy money, but it can also be a warning light, because the dollar is also the world's funding currency. You can have a softer dollar on screens, while dollar funding tightens underneath. That sounds contradictory. It happens more than people think. Let's make it real with one anchor. Meet Lena. She runs a mid-size U.S. importer. She buys specialized machinery from Germany. Her invoices are in euros. Every month she has to convert dollars into euros. When the dollar falls, Lena's invoice gets bigger in dollars. Her costs go up fast. If she hedges, her hedge costs can rise too. So, she is sensitive to both FX and funding. In the next 72 hours, Lena's risk is simple. Another tariff headline, another volatility spike, and another leg down in the dollar. That would hit her next invoice and her hedge quote. Now zoom back out to the market. Why did the dollar drop with volatility up? Normally, risk-off supports the dollar. That is the classic pattern. But patterns break when the source of risk is domestic policy noise, or when investors think U.S. rates will fall sooner than others, or when foreign returns look more attractive at the margin. That's why the rates link matters. Markets do not trade the dollar in isolation. They trade the dollar against rate differentials. Front-end rate expectations move FX first. Then the real economy feels it. You saw that logic around the Fed pause too. The Fed held rates steady, but the market spent the day parsing the path. That is the theme of 2026, not the level, the path. So here's the clean chain. Policy uncertainty rises, volatility rises, risk premia rise, rate expectations get repriced. FX adjusts immediately, then credit and equities catch up. Where does credit come in? Credit is the slow truth teller. If uncertainty persists, spreads widen. If spreads widen, refinancing gets harder. That is when headline risk becomes real economy risk. For Lena, that is the next block. If her costs rise, she may delay orders. If she delays orders, revenue slows for her supplier. If suppliers see slower orders, they cut capex. That is how a currency move becomes a growth move. Now, let's bring in the primary source again. Treasury's FX report is not a trade signal. It is a pressure map. It looks at current accounts, intervention, and trade balances. It tells you what Washington is watching. When a country is on the monitoring list, it means scrutiny increased. That can change behavior, it can change messaging, it can change intervention risk. And that feeds back into the market's second layer, reserve management. If reserve managers tilt even slightly, FX moves, not because of one day's flow, because of the expectation of sustained flow. This is where we stay careful. We do not know the next policy headline. We do not know the next data print, but we can track the system. So, let's lock in the 3 signals early. We will revisit them, and we will tighten them. Signal 1 is the rate differential. Watch the U.S. 2-year yield versus peer 2 years. Watch it against the broad dollar index. If the dollar falls while the differential widens, that is unusual. It says something besides rates is driving FX. That usually means policy risk or flow shifts. Lag is hours to 1 day. Signal 2 is gold versus real yields. Gold tends to rise when real yields fall. If gold rises while real yields do not fall much, that is also a tell. It says the bid is fear or hedging, not just rate math. Lag is 1 to 3 sessions. Signal 3 is cross-currency basis. This is a plumbing metric. It shows the cost of swapping into dollars. If basis widens against the dollar funding is getting tighter. Even if the dollar index is falling, lag is 1 to 5 days, depending on stress. Now, what can break next? In the next 2 to 6 weeks, the risk is a feedback loop. More uncertainty raises hedging. Hedging tightens conditions. Tighter conditions slow growth. Slower growth makes cuts more likely. Cuts expectations weaken the dollar more. Then import prices rise. That pushes inflation back up. And policy gets stuck. For Lena, that is the squeeze. Her euro invoice rises. Her borrowing costs may not fall. And her customers may slow orders. That is a three-way hit. If this persists for months, the story gets bigger. It becomes about allocation. Do global investors demand a higher premium for U.S. risk? Do they diversify more? Do they prefer hedged exposure? Those choices are slow but powerful. One more grounded receipt before we move on. The VIX moving above 20 was the market saying, "I need insurance." That is not a prediction. It is a price. Prices are the market's language. In the next chunk, we'll map the dollar down paradox, when it is benign, when it is dangerous, and how to read the funding layer without guessing. So, when is a weaker dollar benign? And when is it a warning? Benign looks like this. U.S. inflation is cooling. The Fed is closer to cuts. Rate differentials narrow, so the dollar drifts lower. Risk assets can even like that version. Because it loosens global conditions. Danger looks different. The dollar falls, but funding gets tighter. That is the paradox. And the way you catch it is not by staring at DXY. You catch it in the plumbing. Here is the plumbing in plain English. Most of the world borrows in dollars. Banks, commodities firms, and even governments. They borrow dollars directly, or they swap into dollars. The swap price is the cross-currency basis. Think of it as the extra cost over and above rates to get dollars. When that cost rises, dollars are getting scarce, even if the dollar index is down. That is why Signal 3 matters. Cross-currency basis is the first place stress shows up. Before headlines, before default risk, before bank stocks. Now bring back our anchor, Lena the importer. In chunk 1, her euro invoice got bigger. Now, here is the new consequence. Her bank changes her hedge terms. When volatility jumps above 20, banks widen spreads. They demand more margin. They shorten credit lines. They reprice forwards. Lena's hedge is still available, but it costs more, and it ties up cash. This is how FX becomes a cash flow story, not a chart story. If Lena ties up more cash and margin, she carries less inventory. If she carries less inventory, she misses sales. If she misses sales, her working capital looks weaker. Then the bank tightens again. That loop is how a softer dollar can still feel tight. Now, what sets off that loop? Policy uncertainty is one. Tariff threats are a perfect example. Reuters described that episode as spiking volatility. It also described the mood as sell America. Whether you like that phrase or not, it signals risk appetite shifting. Here is why tariffs matter to FX. Tariffs change prices, but they also change timing. Companies pull forward imports, then they pause. That creates data whiplash. Markets hate whiplash. And when markets hate whiplash, they pay for insurance. That pushes implied volatility up. That tightens financial conditions. Then the FX response stops being clean. Now let's anchor the second official receipt. Treasury's FX report is a map of pressure points. It did not just repeat the list, it expanded it. Thailand was added to the monitoring list. That is a concrete escalation in scrutiny. Why does that matter for our story? Because monitoring is linked to intervention risk. If a market believes intervention is possible, it prices that tail. It changes positioning. It changes how aggressively traders lean into trends. That brings us to the dollar down fork. Fork A is valuation. Fork B is credibility. Fork A is simple. If U.S. rates are expected to fall faster, the dollar can soften. That is not scary. It is math. Fork B is the risk. If investors demand a bigger premium for policy noise, the dollar can soften for the wrong reason. That can come with higher volatility, and higher volatility can tighten funding even if FX looks easy. You can see Fork B in the combo tape. Dollar down, VIX up, gold up. That mix means uncertainty is in the driver's seat. That is where signal 2 does work. Gold versus real yields is a clean tell. If gold rises without a big fall in real yields, it is not just rate math, it is insurance demand. Now, let's tighten signal 1. Watch the U.S. 2-year versus peers. If the 2-year yield stays firm but the dollar still weakens, that is a warning. It means rates are not explaining FX. Something else is. Usually flows, usually risk premium. This is also where emerging markets matter, even if you never trade them. When the dollar weakens, carry trades look tempting. People borrow low, buy higher yield. But when volatility spikes, carry trades unwind fast. Then dollars get scarce in swaps. That is the basis move. So the story you're tracking is not, is the dollar up or down? It is the system comfortable lending dollars? Now, the stakes ladder. Next 24 to 72 hours. The risk is a fresh policy headline that restarts the hedging wave. If volatility jumps again, Lena's hedge margin can tighten again the same day, and importers like her can pull back orders quickly, next 2 to 6 weeks. The risk is the inflation feedback. A weaker dollar can lift import prices. If that shows up in CPI goods, the Fed gets less flexible. Then rate expectations can whip back. That whips FX again. It is the policy trap. If this persists, the bigger risk is allocation, not one sell-off. A slow tilt, more hedged exposure to U.S. assets, more diversification, more sensitivity to political risk. That is when Sell America stops being a headline and becomes a behavior. Now, keep this grounded. None of this is guaranteed. This can calm down fast. One softer inflation print can ease rates. One quiet week can collapse implied volatility. And the dollar can stabilize. That is why we track signals instead of stories. So here's the recap before the last chunk. A lower dollar is benign when it is rates driven. It is risky when it is premium driven. Premium driven shows up with higher volatility, a gold safety bid, and tighter dollar funding costs. In the final chunk, we'll lock the what to watch into 3 concrete dashboards: where to look, what direction matters, and how fast it tends to show up. So here's the clean signal check. 3 markers: where to look, what direction matters, and the usual lag. Signal 1 is the rate differential dashboard. You want the U.S. 2-year yield. And you want a peer 2-year, like Germany or the UK. You can also use a broad dollar index as the overlay. What direction matters? If U.S. 2-year yields fall and the dollar falls, that's coherent. That's the cuts are nearer story. If U.S. 2-year yields hold up, but the dollar falls anyway, that's the fork. That's when you suspect risk premium or flows. Typical lag. 2-year yields move first, then FX reacts within hours. Sometimes it's the same session. For Lena, here's the new consequence tied to that signal. If the rate differential narrows, her euro hedges get less punitive. But if the dollar still falls while differentials stay wide, she pays more per invoice. And she has no rate relief. Signal 2 is gold versus real yields. You want gold. And you want a real yield proxy, like TIPS yields. What direction matters? Gold up with real yields down is normal. Gold up with real yields flat is a warning. That means insurance demand is driving price. That usually comes with higher hedging costs and tighter risk appetite. Typical lag. Gold tends to react fast on headline risk, same day. The confirm is whether it holds for 1 to 3 sessions. For Lena, the new consequence is in her bank terms again. If gold is rising on fear, banks get conservative. They widen FX forward spreads. They demand more collateral. That is when her hedge becomes a working capital issue. Signal 3 is the plumbing signal, cross-currency basis and dollar funding costs. Where to look? Cross-currency basis series from major dealers, Bloomberg, or central bank market pages. For a simpler public proxy, Keep an eye on repo benchmarks and any abnormal widening in funding spreads. S offer gives you the baseline for secure dollar funding. What direction matters? If cross-currency basis widens against the dollar funding is getting tighter. If it tightens while the dollar index is falling, that is the paradox in real time. That is when FX is not telling you easy. It is telling you fragile. Typical lag. Basis can move within a day in stress. Sometimes it takes a few sessions to show, especially if the shock is political and not credit. For Lena, the new consequence is the harsh one. If dollar funding tightens, her bank gets cautious. Even if the dollar is down, her credit line pricing can worsen. She can be forced to deliver inventory. That is how plumbing hits a real business. Now, the receipts again, so we stay grounded. Treasury's FX report is the official paper trail. It expanded the monitoring list and points to scrutiny and intervention themes. That is not market gossip. That is policy posture. And Reuters describing the sell America mood around tariff threats matters because it tells you the catalyst. Not the dollar fell, but why the market's mood shifted. The VIX rising above 20 in that window is the market's price for uncertainty. So, what should you do with this? Not trade it. Track it. Next 24 to 72 hours, the key is whether policy headlines stay hot. If they do, implied volatility stays elevated, and FX will keep moving on narrative. Next 2 to 6 weeks, the key is whether the weaker dollar feeds into goods inflation. That can show up in CPI goods components with a lag. If that happens, the Fed has less room. That can snap rate expectations back. That can reverse the dollar move. If this persists, the key is whether hedge demand becomes the norm. That would mean the U.S. needs to offer a higher premium, not just in yields, but in stability. That is the slow regime shift. So here's the recap in one line. The dollar at a 4-year low is not the story by itself. The story is whether FX is moving because rates are moving, or because risk premia are moving. If it's rates, it can be orderly. If it's premia, it tends to come with volatility, gold strength, and tighter dollar funding. Check the 3 signals: 2-year differentials, gold versus real yields, cross-currency basis and funding conditions. That's the risk, and that's the recap. If you want the clean signal check, look at those 3 markers this week. I'll see you in the next one.